Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. The case for a chat for our guest on Talking Point, Ravi Dharamshi, today. We asked him whether the concept of value has changed. He's tweeted extensively about this. Would love to know his thoughts there. Also try and talk about whether some of the high price themes are now baking in all the positives, particularly power or defense, but power in particular. Has the potential been priced in? And he was also amongst the earlier identifiers of the EMS theme. That theme seems to be having a non-stop run. Look at almost every business and they are bagging in more clients and doing well. In fact, companies talking about how India can become an EMS hub. We asked Ravi, how does he think of it? He and his partner have also written a book, and we'll try and talk to Ravi about the book as well. Ravi, there's so much to talk to in the next 20 minutes. I don't know if we'll be able to do all of that, but thank you so much for taking the time out.
Thanks, Neeraj. Thanks for inviting me.
The pleasure is entirely ours. Ravi, let me start off by asking you about this set of tweets that you have put out on the platform X, wherein you're talking about whether the concept of value has indeed changed. And I think you ascribe to that theory. In fact, you espouse that theory. Tell us a bit about it.
So, see, I don't think the concept of value has changed. But what happens is, as the markets have evolved, everybody tries to bucket themselves and I'm a value investor, I'm a growth investor. And I think that is what creates confusion. Every type of investing is value investing. And that is what Warren and Charlie have said over a period of time. And I had tweeted a particular video of Warren speaking about it also. And I think value and growth both are not a mutually exclusive concept. Growth is very much a part of the value equation. If you want to estimate the value of a company, you have to know what the future growth is going to be. There are certain people who completely shun away from doing any kind of a forecast and say, I will buy when the intrinsic value of the company is much higher than what the current quote of that company is. Now, I'm not saying that it is absolutely a wonderful thing, but those kind of cigar butt investing opportunities come very, very rarely, like once in 2 decades maybe, where there is a crisis of sorts where asset prices fall so much that they become very, very attractive in relation to their own intrinsic value. But in a regular course of business, and especially in a market like India, which is a growth market, you will be hard pressed to find opportunities which fit into this particular traditional definition of value. So the value of an asset in simple terms, if you take the formula, is the discounting of all future cash flows. By definition, it is all future cash flows. So you have to know what the future cash flows are going to be. Now, if you figure out that the future cash flows are going to be much higher than what they are at present, because there are certain aspects about business which are panning out now, then you will suddenly realize that there is very apparent value, even though in the traditional PE format, it might not fit. And that is what I have been trying to dispel, that myth that just because on a TTM PE basis or the last year PE basis, a stock looks expensive does not mean it is actually expensive. There is a fine logic why there is a lot of value in it.
Ravi, help our viewers understand the constant pushback to something like this is that, we've seen this tape play a number of times in the past. It looks good till it is looking good, then it tends to correct. And stocks which priced at X valuation at some point of time will come back. And then the last 4 years have shown that expensive stocks continue to do well. I'm not asking you to comment on a Dixon, but I'm using that as an example, right? For a brief period notwithstanding, it's always stayed an expensive stock, continues to do well. There is a Keynes Tech which has continued to do well. There are a clutch of others, power companies or wind equipment companies, continuing to do that for the last couple of years. So how does one wrap her or his head around what can be construed as expensive and what is not too expensive, because there is growth and therefore the value is in the growth of the company? How does one distinguish between the two?
No, I think there's a very simple way. Of course, entails that you do some scenario analysis on what's going to pan out in the 10, 20-year time frame. Often enough, even in the bottom of, right after 9/11, when, the stock prices were dirt cheap at that point of time in September 2001, you would have found that in Asian Paints was still expensive vis-a-vis the market. A Titan was still expensive vis-a-vis the market. Now, at that point of time, you could have said that, these are expensive. Let me buy a 5 PE multiple company. Yeah, sure, you would have bought 5 PE multiple company and made some money on it, not denying that. But you completely missed the point if you just focused on valuation or historical valuation. What about understanding the business? What about understanding the management? What about understanding the prospects of the business 5, 10, 20 years out? And if you would have understood that, then you would have realized that those seemingly expensive stocks were actually the cheaper ones. And the seemingly cheap stocks were actually the expensive ones, because you lost out on an opportunity. You did not understand the prospect of that business. So if you can say that, and I'll take that example of Titan again. Now, it's not like everybody has a clear picture of what's going to happen. But if you could foresee that there's a large, jewelry market out there, Tata's has a trusted brand name, and there is a management in place that is focused on creating that value, then it would have become very, very clear that it's okay if the traditional metric of PE and price to book might say that this is an expensive stock, but this is a long runway. There is a lot of predictability to it, and you can say that the probability of a Titan becoming much bigger company was much higher than, let's say, some XYZ company becoming that large. So focus on identifying that predictable growth over a long period of time, and where markets are actually probably underestimating the kind of growth that can happen. That is where the value lies. I mean, I hope I've been able to explain, but honestly, I'm not very good at articulating as maybe some of the other valuation experts are.
No, but you're undermining yourself, Ravi. I think this was a very good explanation and much needed as well. So let me try and correlate this, Ravi, to the current pockets, one or two that I have picked out for a conversation today before we talk about your book as well, because that's the third one. But the first one, EMS, because you were amongst the earliest identifiers. Now, the stocks have done have had a long run. I mean, I was looking at the Dixon market cap today, 85,000 crores. That's something that's gotten created in the last 4 years. But we have some charts here, and which shows one that the government targets for electronics, finished goods production, and components production. With policy support, base case, some people say, Niti Aayog research and Nomura research suggests that FY30 base case, look at that growth from 86 to 253, and with policy support from 86 to 350, that's nearly a 5x jump in finished goods production and a 10x jump in components production. And viewers, the other piece that one of the research notes suggests as well is the electronics production as a percentage of GDP will shoot up from circa 3.8 currently to maybe 5.3 by the end of FY27. Ravi, are these stocks which are optically expensive and may look cheap as earnings growth comes in, or are they actually expensive?
So, see, today, no doubt about it, they are factoring in a lot of the future. So there is a risk to the extent that what if the future is different than what the stock prices are suggesting? However, I'll just give you a framework on how we think about it and how we attach probabilities to the outcome. And that might give you some sense on how to evaluate this. So 2-3 years back, when this sector was actually getting born, or where new companies were getting listed, at that point of time, this valuation concern was actually totally not required. Why? Because, see, we tend to track a lot of these trends on a 10-20 year horizon, but only when they cross a particular inflection point that we bring it on our radar or make it into part of our investable universe, is that the growth is going to pan out in the next 5-7 year and not in some 10-20 year horizon, which might not be my investment horizon to begin with. So when government in 2014-15 started talking about Make in India, and then they came out with a policy for electronic manufacturing. We knew that this is the beginning of a particular mega trend. However, we waited until, Samsung came here, Apple came here. Once the OEM started coming here, and of course, we all start with low-end assembly work. And then the ecosystem around it started developing. That's when you keep your eyes out for companies where there is some differentiation, where they are showing some signs. Who are these large OEMs beginning to work with? Those are the companies that you should be focused on. And then you have a reference point, how this particular thing has panned out, whether in China, whether in Taiwan, and someday we will have our own Pegatron, Winstron, Foxconn out of India. Yes, there is all possibility and likelihood that we will have, because government has created that required ecosystem and the required ingredients from where the entrepreneurs can actually start charting their own path. So that is what tells you that give or take a couple of years, this story is going to pan out. And in that kind of a scenario, you don't try to value those company on what the current year's earnings multiple is, but you try and build scenarios, what kind of size this company can become, what kind of profits this company can make in a 3-5 year horizon, and then see vis-a-vis that scenario, is the stock still very attractively valued or very cheaply valued. And in that also, you don't have to make extravagant predictions or forecasts to justify your position. Even in a base case scenario, if it is attractive enough, then you can let the upside you surprise yourself. That's how we think about these things.
Well, maybe that's how money is being made these days as well, Ravi. So thank you so much for that example. Wonder if the same analogy applies to power. Again, I could mirror those charts, Ravi. Remove EMS, put in power, change the words, and the bar charts would look the same in terms of targets, etc., right? And the stocks have also run up. But it's a different sector, per se. How do you think about this space?
So when you say power, I'm assuming you're talking about power equipment companies. Or are you talking about power
equipment generation. Okay, let's stick with equipment. Let's start with that.
Yeah, so again, the same thing. What is the size of the opportunity? How soon will this opportunity pan out? See, people talk, we don't like to talk in terms of 10, 20 years. We like to talk in terms of 5-7 years. And is that opportunity going to pan out in that 5-7 years? Basically, will the government be forced to spend money on building power transmission infrastructure, or even private sector will have to spend that money? If you see today, for example, for all the renewable generation that is coming up, the single biggest factor that is impeding that growth is the connectivity to the grid. So basically, you need to put those transmission lines in place today if you want the entire energy transition to succeed. Otherwise, we would have failed. It's like paving the roads before selling cars. You cannot sell cars if there are no roads available to drive. So first you have to pave the road. So power equipment companies are essentially catering to that opportunity of paving the roads for energy transition. And that spend needs to happen in the next 5, 7, 10 years. And because of that, and the delta is huge in terms of spend. If X was being spent 2 years back, in the annual number for that X will become 3 to 5X in the next 5-year horizon. That's a huge delta. And then there are very few companies who are catering to that kind of an opportunity. So there is a huge delta in terms of opportunity, and now there is a right to win of certain companies, which is why the stock prices are running probably slightly ahead of even ordering. We saw the same thing in defense as well. Way before the orders started coming, the stock prices started moving. And with every order, the stock prices have been going up. So this is how usually a cycle plays out. Now, of course, probably I can say defense has reached a point where ordering has kind of reached a kind of a peak level. And now you are carrying the entire execution risk ahead of yourself. Now, that not to say the opportunity won't pan out, but now the risk reward might not be that favorable from the next 5 years perspective.
Got it. Okay. Point well noted. We have time for one more question, so I'm gonna now extend the power thing to a green revolution giga trend, and I believe that's the book, Ravi, that you and your partner Varun have written. I was lucky to get a copy of that book, Ravi. I would love to understand in brief. We'll probably do a separate show on this. But today, for a brief, in the next 3 minutes odd, can you tell us a bit about what is the message that you're trying to convey from an investor's perspective? Anybody who's an investor and listening to you right now, trying to think about this theme and trying to get an excerpt of what you're trying to say, what would you mention?
Yeah, no, thanks for that question, Neeraj. So first of all, the way we look at this is that energy transition is not new. Okay, we have been moving from various forms of energy. There was a point in time where coal was a big percentage, then oil took over, and now oil is being replaced by renewable. But what is different about this particular energy transition is it is being driven not by natural resources which are to be dug up from the ground, but it is being driven by technology which is made in factories. So there is a learning curve involved over here. These technologies tend to keep improving. As you produce more and more of it at a scale, they become cheaper, they become more efficient, and they are able to extract more. So that is the main difference between this particular energy transition as against the previous one. Another thing that's different about this particular energy transition is that there is a time-bound nature to it. It's not like it will take its own due course. We have to achieve a certain level of carbon emissions, and to achieve that, we basically, to reduce that carbon emission, we need to achieve some level of renewable penetration for those carbon emission norms to be achieved. So there is a timeline to it as well, and we always prefer opportunities that come with a timeline, that this has to be done in the next 30 years, this has to happen in the next 10 years. That is when opportunities become real. So that is the point. Now, the backbone of this entire energy transition, in my opinion, is going to be solar. Why solar? Why not nuclear? Is because there are three things that are needed for a particular technology to be adopted at a mass level. Cost, basically, which means affordability, accessibility, and acceptability. So with nuclear, cost is an issue. With nuclear, accessibility is an issue, because people, there is something called as NIMBY effect. Not in my backyard. If you were to put up a nuclear plant, let's say 10 kilometers away from Bombay, I don't think the entire city is going to agree to that plant today as of now. So basically, you will have to go to remote location, which might probably increase the cost even further of evacuation and everything. So a technology can become mass only when it is free, accessible, affordable, and it has reached that mass adoption level. So yeah, so those are the points that we want to make. Now, this energy transition as a theme transcends many sectors. Okay, on the generation side, on the transmission side, on the consumption side, on the new technology side, on the financing side. So from time to time over the 30-year period, some subsectors from the energy transition will end up being a beneficiary. I'll give you an analogy of internet. The entire pipelines for internet were laid in the late 90s, early 2000. However, the eventual winners of that pipeline laying probably are being discovered today. Google, Apple, Microsoft, AI, those are the beneficiary of the pipelines that were laid 20 years back. So think of this energy transition also as a pipeline exercise that is going on for the renewables. And at some point of time, in 20 years down the line, we'll see that new business models have suddenly cropped up which leverage on this particular thing. I'll just give you one example that I can think of right now.
Right.
Is heavy manufacturing industries where the power cost is very high. We are already witnessing that the power costs are falling to zero, or it is actually power is becoming a source of revenue rather than a source of cost. For example, let's say spinning in textile is a very power intensive business. But if you have your own solar plant, you are actually making money. You are supplying power to the grid. And your competitor now has no choice but to actually install a solar plant of its own, because otherwise they will not be able to compete with you at all.
Yeah. Wow. Ravi, this calls for a longer conversation. We should do a very long format conversation on this, because this is a very interesting thing. Unfortunately, I don't have time today, but I urge you that in the next 15-20 days, we should try and get you to the studios and try and do a very long format conversation on this. But thank you so much for giving us a snapshot of this today.
Thank you. Thank you so much for inviting me.
The pleasure is ours. And viewers, that's all that we have time for on this very informative edition of The Talking Point. Thanks so much for tuning in.